Hello, everyone. Welcome to the second Lido Poolside Community Call. My name is Cian, and I'm Head of Institutional Relations at the Lido Ecosystem Foundation. For this call, we will be hosting a panel with some of the industry's leading ETF issuers and experts. And we're going to be trying to understand the differences between native staking, liquid staking, and crypto ETFs more broadly, and the benefits each can bring to crypto ETFs. After the panel discussion, we will go through what's next for Lido Core in 2025 as well. But before we kind of move into the panel, just a quick note on the Q&A. So we'll address your questions after each agenda section, but feel free to kind of drop each question into the chat as we move through the agenda. So you can post your questions on whichever platform you prefer, so Twitter, LinkedIn, or YouTube. Just a small note on YouTube that on the chat function, it doesn't currently support viewers sharing links. So if your question includes a link, please post it in Twitter or on LinkedIn. So without any further ado, let's kind of jump in and go straight to the panel. So I'm going to ask each one of our panelists to introduce themselves, and then we can jump straight in from there. So Bradley, maybe we'll start with you first.
Okay, good. Thanks, Cian. Hi, my name is Bradley Duke. I am head of Europe at Bitwise. I'm one of the executives on the executive team at Bitwise. And I was one of the founders of ETC Group that was acquired by Bitwise last August. And that's been a great merger of the companies, very similar in nature and culture. And so ETC Group is no more, it is only Bitwise, and Bitwise today has around 16 billion client assets, and we only do focus on digital assets for our investment products.
Matthew?
Hey everyone, thanks for having me. I run the digital assets research at VanEck. VanEck is a mutual fund and ETF sponsor. We have about 5 billion in digital assets related strategies, both passive and active. And I also run the Node ETF, which is an actively managed fund that invests across the space. So good to be with everyone.
Thanks, Matt. And Davila?
Yes, hello everybody, great to be here and thank you for having me. So I am Davila Shilenskite and I'm responsible for digital asset research at WisdomTree. WisdomTree is a global exchange-traded product issuer and we have broad diversified business. In Europe, we manage over $50 billion in assets under management, and the crypto represents approximately 3 billion of that. So look forward to answering questions here.
Excellent. Well, guys, again, thanks so much for taking the time and speaking to the community. Davila, I might kind of start with you, if that's okay. So I'm sure the audience is kind of trying to understand what the difference between ETPs and ETFs is and how this applies to kind of crypto. So maybe if you wouldn't mind just explaining what crypto ETFs are.
Sure, I would be happy to. So in Europe, we call these products exchange-traded products instead of exchange-traded funds. And this is primarily due to UCITS rules. So in simple words, in Europe we have regulation, which is called UCITS, and which has concentration limits. So if a product is 100% Bitcoin exposure, then it can't be UCITS ETF because it's 100% Bitcoin, and UCITS rules allow maximum 20% exposure to any individual token. So in Europe, what we do is we use umbrella term, and umbrella term is exchange traded product, and there under that name you have exchange traded fund or ETF, exchange traded note or ETN, and exchange traded commodity or ETC. But for clients, it does not make any difference whether they're investing in ETF or ETP if both are physically backed, because they still get exposure to the cryptocurrency that they want to have exposure to.
And Bradley, maybe kind of moving to yourself. So, like, why do you think institutions have kind of picked up so much demand or interest in Ethereum right now from an ETF perspective?
Well, I think it's got a lot to do with the fact that Ethereum is a it's the success of Ethereum itself. It is a sorry, I've just had I'm in a hotel room and I've just had somebody walk into my room completely unannounced. So excuse me for my for that. So I'm sorry for that. But anyway, so what I was saying is, I think it's because of the success of Ethereum itself. Today, what is of interest to people, and these large trends that are happening in the space. Ethereum is dominant in all of them. Okay, so stablecoins are a huge, huge and growing, and Ethereum has a dominant position in stablecoins. Ethereum has a dominant position in DeFi, and also tokenization is the other main theme that where Ethereum has a dominant position. It's got the massive developer community, and is seen increasingly as a really a blockchain and a platform where people can earns cash flow as revenue. It has a large and growing community. So all these things are attractive to the institutional investor because they can back into a valuation model, traditional finance valuation model, and arrive at some numbers, and that gives them comfort. But it's just it's a great success story, and I think it's also being a proof of stake blockchain generates yield, and that's also attractive. Everyone's looking for yield, so you can get not only price performance, benefit from the price performance, but some yield on top of that is very attractive.
Absolutely. And Matt, maybe just a quick question for you. So obviously, like, VanEck has been a leader in the space, or crypto ETF space, for, I suppose, quite a while now. So, like, what was the big driver from VanEck's perspective to kind of jump headfirst into crypto?
Yeah, the DNA of our firm is actually in gold and gold mining stocks. So we're a family-run private firm. The VanEck family controls the company, and the founder in the late 60s was running an international mutual fund, and he got conviction that inflation was going to accelerate and the gold peg would not hold, and he pivoted that fund into all gold mining stocks in the early 70s, and that really built our firm. It was the best performing mutual fund in the 70s. So our DNA is in hard money and macro, and when Bitcoin came around, the family got conviction early that this could be a potential competitor to gold, and that it was best to diversify. So we were the first kind of traditional fund manager to file for an ETF in 2017 for BTC. Obviously, the regulation didn't approve that, but we invested off of our own balance sheet. We do think of BTC as kind of distinct from the rest of the smart contract platforms because of its connection to real world energy. But for Ethereum and other smart contract platforms to really take margin away from the Web 2 companies like Google and Facebook and Apple, like we think of ETH as an open source app store where any developer can build a product and reach a global audience, and it's that always on uncensorable global phenomenon that is changing the nature of how capital is formed, and social media has a lot to do with that as well, with kind of retail taking a bigger percentage of market activity. So we've been in ETFs for 20 years. It was really a natural extension to include digital assets in our ETF strategies. And this year, I think what we found is that our active strategies have performed better than the passive strategies. So we've leaned into that across venture, token picking, and now equities as well. So the ETFs for the strategy that I manage, it's mostly an equity product, but we can hold crypto ETFs up to a certain weight. We have the VanEck Ethereum ETF inside of that fund, and I'm really looking forward. I'm sure we're going to talk about this, but staking, brings the potential for additional returns without too much additional risk. So that's a combination that, is going to be appealing, I think.
Yeah, and look, Matt, since you mentioned that, like maybe just a kind of an open question to the group, like why is ETH staking for ETFs like such a popular topic right now? Like why is it getting so much excitement on Wall Street?
It's simple, as it was mentioned.
Go ahead, David.
I was just going to say that everybody is looking for yield, and crypto investors, they want yield, and they want as much yield as they are able to get in a risk-managed manner, and ETH is offering that. So for the products that can stake, clients very much show preference for the ones that enable staking. And sorry, Matt, I interrupted you.
No, it's just like the simple answer is money, right? Investors are here to make money, and the difference in returns between staked and unstaked ETH is material. I'm looking at here, like over 1 year, in staking your ETH added 300 basis points, so 3 full percentage points of return. Right. We have a Ethereum total return index in partnership with Figment, and over 3 years of that index, it's 35 percentage points difference of return. It's just too material to ignore. And all of these cryptos, they have generally, aside from Bitcoin, they have high issuance rates. Okay, Ethereum's is lower, but you're getting diluted if you're not participating in the consensus mechanism and earning the rewards. And so, most TradFi investors, when they buy a stock, that they are hoping that the company is not going to dilute too much and that they'll buy back stock, at least to offset the dilution from share-based compensation. And staking offers the ability to kind of automatically buy when the price is lower and avoid dilution. So the top 10 crypto coins have an average inflation rate of 10% a year. That is really meaningful over the course of a full year, and you have to be staking to avoid those dilutions.
Yeah, I think also the fact that what's going on with the regulator in the US as well is playing a part here, because the ETFs in the US, of course, it's only Bitcoin and initially only Bitcoin and Ethereum that were approved, and Ethereum wasn't approved for staking ETPs. And of course, more recently, there's the generic listing standard has come out, which has opened the door for a bunch of other tokens to be included in ETFs, and also staking is going to be is allowed going forward, and that's why I think, especially on X, there's a lot of excitement about this, because the products in the US didn't allow that previously.
But even for the products in Europe that do allow staking, I spend a lot of time explaining to clients what staking is, how it works, and how staking is not in any way similar to lending. Because in staking, when you participate in staking, you participate in the governance of the blockchain, and you do not have counterparty exposure. You do not have coins leaving the cold storage security. So a lot of education is required. So even though clients want additional yield, some of them may be afraid of it because they do not understand where it's coming from and what they are rewarded for.
And like in terms of these kind of ETFs, is the full product being staked, or how would that be typically managed?
Well, okay, sorry, I was just, it is a problem, right? So, and this is actually where, this is where Lido comes in. So it is a problem. We've seen not only the exit queues on Ethereum for unstaking, going up extraordinarily after the Kiln event, but now with Grayscale, starting to stake their products, the entry queue into for staking on ETH is jumping up, and so staking a meaningful or as much as possible is always, as an issuer, Bitwise always wants to maximize the return for the investors, and that means staking as much as possible. And of course, if you've got these with a +2 settlement cycle for the ETPs, and a 40, sometimes a 40+ day unbonding, there's a mismatch. Of course, it's massive, and that's actually where it can be useful to bridge. There's a few ways you can bridge. You can bridge with finance. You can bridge by not staking the full amount, and of course, liquid staking tokens like Lido are very useful in this situation.
Matt, did any thoughts?
Yeah, from my side, so at WisdomTree, we risk manage our staking approach. So what this means is we only stake as much as we can, keeping in mind that if a large number of our largest clients came to us on the same day, we want all of them to be able to redeem on that day with 2+2 settlement. So sometimes we decide to stake less and have slightly lower staking return because we view illiquidity risk as being too big to take.
Yeah, similar story. So, like for our EU funds, Ethereum and Solana, you can go on the website, and we're pretty transparent about what the effective yield is and what percentage of the coins we're staking. For ETH, right now it's 35% because the withdrawal queue blew out so much in the wake of the kiln events, whereas for Solana it's more like 75-80%. So that really highlights why I think a staked ETF would be valuable in the US. You may have seen that VanEck created an entity in Delaware in preparation of such a product. The government shutdown is currently kind of slowing down new product innovation in US ETFs, but we do think that a staked ETF would fall under the SEC's new generic listing standards, and that it is more important to get that out because of the longer withdrawal queues for ETH.
And Bradley, maybe this question's for you. Like, how do you kind of balance like ETFs from a client perspective? So, for example, obviously they want as high a return as possible, but from like a risk perspective, like instead of just having everything staked with a single node operator, do your clients care a lot about like diversity of node operators and who it's being staked with, or what would those conversations typically look like?
Is that who's that for? Sorry.
Oh, for you, Bradley. Sorry.
Okay, fine. Look, it really depends on the sophistication of the client. Some people really don't care. A lot of investors, they just want their return. They kind of trust that you're making good decisions on their, on their behalf. And I mean, in fact, we have clients who don't even want staking. We've got the ones who they don't understand it. They don't like the word slashing. The risk department doesn't, or otherwise there's sometimes tax reasons why it's not attractive to them. So, but the ones who do, there are some players who are super sophisticated. At Bitwise, we acquired a company last year called Attestant, one of the largest ETH stakers in the world. And they're experts. They only did ETH staking for the beginning part of the company. I think they support other tokens now. But for people who are conversant and experts and want to have that in-depth discussion with them about maximizing returns and what tricks can you do to maximize returns, to capture more of the available the opportunities that there are, we're happy to set up a conversation with them, and so people can speak to the experts who do this day in and day out, and they can give them a better answer than I could for those kinds of questions.
Yeah, big shout out to the guys at Testing to do fantastic work.
Thank you. Yeah.
And maybe to kind of pivot the conversation a little bit. So one of the big kind of hot topics right now are these DATCOs in the US, so digital asset treasury companies. And I think it kind of feels like they've probably gotten a head start compared to ETFs that don't have staking yet. So again, maybe a general question to the group: how do we see DATCOs competing with future staked ETFs?
I can kick off by saying that for most investors, or at least investors I talk to, large institutional investors, they want physically backed exposure. So if they want to invest in ETH, they want to have physical ETH exposure, and most of them do not want any leverage around it. And that, in my eyes, are very much providing leveraged crypto exposure, and that leverage differs from their financing level or where they are at. So while that's a nice workaround some of the limitations that investors may have, especially in some countries, I hear that there are tax advantages to invest via DATs instead of ETFs. For most investors, European investors, ETPs are a better way forward than DATs for crypto exposure.
Yeah, it's a fascinating question. I think of like DATs are kind of like alpha vehicles where you're betting on a management team to try to generate yield, and ETFs are more like beta where you're just getting the underlying return. So for our strategies, we've been underweight the DAT complex. We've written a lot of research about why that is. We think that the ending experience for investors when they buy an ETF, they want to be able to redeem it at the net asset value. That's one of the reasons why the GBTC structure was so subpar. We could argue it actually caused the last crisis by trading at a discount to NAV, and that type of volatility, it creates profit opportunities for those who are very nimble. But when you're around since 1955, like us, buy and hold is a good strategy for the long run, and ETFs offer the cleanest way to get exposure to that buy and hold. So I think some number of DATs will succeed. Hopefully one from each coin will be able to trade at a sustainable premium through the use of intelligent leverage and connected management teams. But longer run, just look at the performance of some of these DATCO ETFs, and it's not the type of risk reward that most folks want.
Right, and to that point, I agree. Entirely with what Matt was saying about beta versus alpha, strategies and approaches, and I think it's very much about risk and return. This is you can for higher risk you can get higher return through a DAT. MicroStrategy and on BTC was one of them. Of course, there's some very well run Ethereum DATs that have started up, and many are joining the fray. And with that, you are adding a layer of risk, because you've got, of course, leverage risk, and also there's the risk of not just having this exposure to just the token itself, but human decisions and maybe frailties or maybe financial engineering that wasn't thought through correctly, and so it's really about risk appetite. That's, for a lot of people, it's perfect. To Davila's point as well, a lot of people will don't have the ability to access ETPs through their brokerage account, but they can buy, Bitmine or Ether Machine or whatever it is, right? So, and that's somehow that there's this kind of disparity where a crypto ETP is seen as higher risk than a regular listed equity, and is restricted from access to certain groups of investors.
Like, is there a world where, say, a DATCO would buy like a staking ETF? Would that be part of their strategy potentially?
I think so. They would, with like a small percentage. If they own more than 30% of their balance sheet in a security, then there's tax implications for that, and listed corporates can't do that. They can own, say, 10% of their coins in an ETF, and for that they may get diversification of custody benefits. They may get different types of cross-margining opportunities. They may get marketing partnerships, right? So I think it's reasonable for a small percentage, but not for a large percentage.
Yeah, and I think also, look, it's about capital efficiency. If they've got using a prime broker that is allowing them, more leverage, or using the ETPs as eligible collateral, rather than direct holdings of ETH. That's obviously going to be attractive within the parameters that Matt was talking about. There's a lot of things that play, but I think over time, as the banks get more sophisticated and more switched on to crypto, I think that will change over time as well in terms of the capital efficiency argument.
And Davila, maybe a question for you, since you're in London. So, obviously, all these big DACos seem to be in the US right now. Is there much activity happening from a European perspective, from a DACO element, or is it still ETP driven?
It's very much ETP market here in Europe, and I hope that it will continue to be ETP market, because as I mentioned, most investors, all that they want is physical crypto exposure. They choose the exposure by going into Bitcoin or Ethereum or Solana or any other product. And as Matt was mentioning, they want to get NAV when they're redeeming. Of course, it will be NAV minus the bid spread, but they want to know what they will get. And there is no real reason to go around crypto ETP investment, because now all across Europe, including UK, for both institutional and retail, from more or less now, crypto ETPs are accessible.
Okay. And we have one question from the chat, so I'll just read it out loud. So, how do you think providers of staking services are going to be evaluated and/or regulated?
So when we as WisdomTree engage with different individuals and different companies who want to provide staking services, we always try to understand how they compare to their peers in the market. So they achieve slightly different staking returns among them. And it's also very important to understand their operational models and the fees that they're taking and everything else. So there is a lot of interaction between ETP issuer and staking provider, but I'm sure that every single ETP issuer will stress slightly different points when they assess which parties they want to work with.
Yeah, there's a few elements. One is kind of size and scale, transparency, right? So I think that public companies do have a bit of a benefit here. We just filed our latest prospectus for the Solana ETF, and our staking partner is listed in that prospectus. It's a public company, so being able to see, the balance sheet through those regulated financials. Being SOC 2 certified, which is a compliance certification that proves the robustness of back office processes, and then memeability, of course, is always in there. What's the marketing impact of the partnership? But those are the main elements.
Bradley, any thoughts given the close relationship with Attestant?
Yeah, look, I think on top of the list, as both both my co-panelists have mentioned, is performance is obviously at the top of the list. You're just benchmarking. How have you done? How lucky have you been as well? Because there are degrees of luckiness, and just the performance numbers don't lie over a long period of time. Track record as well. Who the people we're dealing with? What's the business looking like? Who are they? There's a difference between more retail focused staking providers and ones that are focused on the larger stakers in terms of just that their approach, and I think it's always caveat emptor. The buyers should do their homework and review the choices before making those decisions. It's a big decision. It can really impact the ultimate performance. So
great. And maybe one final question before we wrap up for everyone. So let's say, for example, we fast forward 12, 24 months down the line. what would a successful staked ETH ETF look like in your view, and who benefits the most from that?
The most successful, I would say, the levels that's staked still allows liquidity to remain within the product. So the product is taking as much as it can, and clients are able to redeem on daily basis with T+2 settlement. And also, if there are any slashing events, that insurance reimburses the product, because investors in the product are innocent bystanders, and they should not pay for the mistakes or actions that some validators may produce. So investors need to achieve as much staking return as they are able. The product needs to remain liquid, and everybody needs to be protected from slashing risk.
Yeah. I think there's something that I've noticed is that, on Bloomberg, when you look at crypto ETPs in general, it highlights the TER. With staking ETPs, it doesn't actually show you, a couple of metrics which I think are really important. And one is, what Davila just mentioned, and that is what percentage of the assets are staked. And then I think another even more important metric is how much of the staking returns are being shared with investors. And that kind of transparency, I think, to build trust with your investor base is very important. And it's often concealed. And that's ultimately, it's the investor's risk. It should be, or the most of the return should be theirs. And that should be, there should also be transparency with that. And I would like to see that evolving over time in these platforms that are showing the, where you can look at different, Bloomberg, for example, or others, where you can actually see, what percentage there should be disclosure on that level.
Yeah. So I'll put up some numbers. There's roughly 30 billion in Ethereum assets. I think if staked Ethereum products could capture 10% of that 3 billion or so, that would be a success. And more of the measure would be when you look at institutional holders, right? Usually fund are basically simply assets that are strategy starting to integrate Bitcoin and ETFs there to provide products. If you could see some rates where well-known shows staking ETF over the spot product, that would be a big validation and proof that these are being used as building blocks in our portfolio.
Super. And guys, I lied. There's one final question we just got from the audience. So, how do you value the fact that the Lido protocol is governed by a decentralized autonomous organization, or a DAO, and how important is that to you? And I suppose the second part of that question is, do you think DAOs are essential or not?
Yeah, I'll take the first part. It's important to us. VanEck has made a donation to the open source community around both Bitcoin and Ethereum because we are philosophically aligned with the open source nature of the project. And as I noted, established an entity in Delaware creation of the Lido Vibes ETF, and so that's the only such Ethereum project that we have.
Super. Davila, any thoughts?
For us, it's every single protocol that we interact with or look at. For us, it's very important to understand the governance model, and DAO makes sense. So DAO is decentralized, and DAO is something that we are comfortable with.
Mm-hmm.
Look, I just to close off, it's like, in the end, there's a very fervent community out there, and they, these DAOs exist for a reason historically. If over time there's a shift away and something else comes up, or a different different mechanisms that are going to keep the stakeholders and certainly the community, the enthusiasts happy and satisfied, then this is a fast moving space. Things change, they migrate over time, I think the emergence of the DAT is a good example that, obviously it's a TradFi structure, not a DeFi structure, but it just shows up, from one day to the next, a new thing. We weren't the phrase DAT didn't even exist, I think, 2 months ago, and so it's fast moving. And I think nothing is static, and structures that may work now may evolve over time or may stand the test of time. So I think people just need to be fluid and open with what the future brings.
Brilliant. Well, guys, thank you so much for your time and such insights. I think you've made everyone incredibly excited about the potential future of a STEETH ETF and ETP. So again, thank you so much for your time. It was really valuable.
Thank you.
Thank you.
Excellent. So kind of moving on from there, the next part is a quick update for those who are collecting the Lido oats. So we've got something really special for you, so make sure to get your phones ready. You should now see a QR code on your screen. So if you scan that, and you can visit the Glass page where you can claim your on-chain achievement token for watching this call. So as usual, the minting is gasless. Moving on from that part of the show, the next section is an update from Will Shannon, who is the head of node operator mechanisms at Lido, and he's going to give you some insight in terms of what's happening with Lido over the next year and coming years.
Hey everyone, thanks Keen. So as Keen mentioned, we're going to be talking about a proposal that went live in September. This is related to the future of Lido Core. So Lido Core is what people have traditionally known as Lido. And this is important in the context of Lido V3, which is coming in this November, that will add support for ST vaults, which sit to the side of this. But I want to just start this off by basically checking into where Lido is today. This is a protocol that has 3 different modules: the curated module, which runs the majority of stake, the simple DVT module, and the community staking module. And these 3 modules have over 700 node operators utilizing the protocol to run validators. I think this is really, really important to recognize, because at the beginning of 2024 in January, there was only 37 node operators running validators via Lido. So there's been tremendous growth in the node operator set. And actually, like right now where things are heading, both the community staking and simple DVT modules combined are actually on track to surpass the largest permissionless staking protocol by stake amount this year. Within the curated module, there's best-in-class geographic, infrastructure, and client diversity. And with the adoption of dual governance, protocol governance has very much been hardened. So as we sit here on October 16th, I can very, very confidently say Lido is the most decentralized at-scale staking protocol. But with that context, I want to talk a bit about where the staking market is headed. So anyone that is in the industry could basically tell you things are more competitive than ever. While the Lido DAO has been investing in this decentralization, this massive node operator set expansion, the hardening of governance, market share has fallen by about 10 percentage points. And this is driven by many, many different reasons. We've seen a resurgence in centralized exchange staking. We've seen new novel mechanisms like restaking. But there's also been some other factors that are slightly more within the wheelhouse of Lido and direct control. And one of these things is, for example, fee compression. So large professional node operator fees have compressed in many cases to between 1 to 3% of staking rewards. In some cases, actually even lower than those numbers. And in many cases, these node operators are also bundling these with insurance. And in the past, node operators have generally lacked incentives to direct stake to Lido Core. That's because stake would be distributed across the various modules. They would be distributed across the different node operators. And so effectively, node operators have been competing at the BD level. So given this context of most node operator fees now being between 1 to 3%, it's important to reassess where fees are from the Lido perspective. Lido has a 10% staking fee. 5% of those in the curated module have traditionally gone to node operators. 5% of those have gone to the DAO. But that current structure doesn't reward decentralization efforts of node operators that spend much more resources in terms of having great infrastructure decentralization or using lots of clients. And it doesn't have any kind of recognition of ecosystem alignment. So there has been some changes that have already started to try and bring things more in line with where the market has gone. Lido Core already started to adjust fees with the second version of the community staking module, which just went live about a couple weeks ago at this point, where permissionless node operators in the module now receive a 3.5% reward share. And for node operators that are independent community stakers or identified community stakers as part of the ICS framework, after their first 16 validators, these node operators also now receive a 3.5% reward share. So with that said, we've made a proposal that would be going live for snapshots in November with potential implementation, if accepted, in December to reduce fees for node operators within the curated module. And the expectation is to do this across 3 different tiers initially. So the first would be the standard node operator tier. And this is where we would expect that the majority of node operators would fall into in terms of category. If we think about this across key ranges, and when we talk about the future updates coming in 2026, this will make a little bit more sense when we talk about fee curves. But for standard tier node operators, the first 1,000 keys would have a 5% fee for the node operator. This is to reflect the higher fixed costs that Lido professional node operators have to basically be ready to support thousands of validators worth of stake, to have on-call schedules, to be responsive when it comes to incidents. The next 2,000 keys would have a 3.75% range, and all keys after that would have a 3%. But what that means, based off the fact that most node operators in Lido today in the curated module are running over 6,000 validators, that would be a blended fee of 3.5%. The next is the extra effort tier. And I think this is pretty interesting. So this would basically follow an assessment from the node operator mechanisms workstream, which would then be included in the proposal for the DAO to take into account node operators that have historically spent a lot of effort in terms of geographic decentralization, using infrastructure that is less common across the network, having very distributed or diversified client setups, and then as well as Lido ecosystem involvement. So for example, node operators that hold LDO, participate in governance, bring stake to Lido, could potentially receive a 4% reward share. And finally, client teams is something that we would love to continue supporting. So there's about 6 or 7 client teams that are part of Lido today. These client teams develop execution layer, consensus layer, and validation clients for Ethereum mainnet. And generally, we would like to continue to support funding those efforts as these are very important public goods for the Ethereum ecosystem. So from my perspective, the proposed changes would really allow the Lido DAO to remain competitive and adapt to this changed market environment. The DAO has spent significant amount of revenue over the last years, strengthening the protocol by improving its decentralization and robustness. Dual governance is an incredibly novel mechanism that hasn't been seen really in the ecosystem at all, and especially considering the size of Lido is even more important. And when you consider again that Lido's gone from 37 to over 700 node operators in just 18 months, with many more planned to be onboarded in the coming months, I think that these things are important and will continue to be important. But given market share changes, given the way the environment has changed, also very important for the protocol to now invest in growth. But while we want to invest in growth and while we think this is important, it's also really important to fund initiatives that improve the decentralization of the protocol. And we think that with the changes that we're going to talk about next, we can basically have the best of both worlds. So first, we'll talk about the staking router. And so the staking router is the top level contract that supports modularity in Lido. This supports the registry of staking modules. It supports stake allocation, the distribution of protocol fees, and Lido v2 basically brought through the second version of the staking router as well as withdrawals. And that paved the way for the community staking module and simple DVT module to onboard hundreds of operators across the protocol. So with staking router v3, the main changes that are expected to come are first, the adoption of a balance-based accounting system. So this governs the deposit and withdrawal operations for the protocol, and it leads right into the next point, which is support for consolidations. So the intention is to see validators from the curated module consolidated into 2048 validators. This would cover intranode operator consolidations, so basically allowing node operators to reduce cost and reduce the amount of validators that they are actually managing. This would be great from a network perspective, and also importantly, between modules. So as we add the second version of the curated module, which we'll talk about, validators would actually be able to be consolidated from CMV1 to CMV2. The third mechanism is called ValMart, or Validator Marketplace. And this would be a novel stake distribution mechanism that takes into account a bunch of different parameters that will be introduced with curated module v2. So curated module v2 is an upgraded version, an updated version of this curated module that has existed with Lido from the beginning. And this would help refine the protocol's performance, risk coverage. It would reward ecosystem participation, all while preserving decentralization and competitiveness with Ethereum's landscape. So the four main features we'll touch on are bonding, operator types, custom fee curves, and this new stake distribution and redistribution mechanism I mentioned. And what's really cool here is that these features are both leaning on the experience from the curated module that has been around since 2020, but also from CSM. It adopts a lot of the features that have now been tested on mainnet with CSM, with hundreds of node operators running validators there. So the first we'll talk about is node operator types. And this would basically allow the protocol to have a mechanism for categorizing node operators based on shared characteristics. This would allow for really interesting risk management and risk mitigation mechanisms, and also allow for ways to enfranchise the support for node operators like that are client teams, for example. So some of the ideas of node operator types we're considering are professional trusted node operators. These would generally be the node operators that were onboarded to CMV1. Next would be professional operators. This could potentially allow for easier onboarding of new node operators to the curated module. And these node operators might have different limits on the amount of keys. They might have different bonding requirements or performance requirements, etc. Public good operators would be very similar to the client team tier I mentioned earlier, basically allowing a way that the protocol could have client teams or open source software providers represented. And this could be represented with a higher fee share, different bonding terms, things like that. Next would be decentralization operators. And so this would be another way to incentivize node operators that are spending more resources on distributing and running distributed validator setups across geos with more expensive infrastructure, more diverse client setups, and really making sure that there is still a focus on having a best-in-class operator set in terms of decentralization. Next could be verified multi-operator DBT clusters. And so this is interesting in the context of the simple DBT module, which is expected to be wound down in 2027. Potentially, you could see consolidated validators from that module move into the curated module V2, where they would also potentially be able to take advantage of these features. And then finally is intra-operator DBT clusters. And so these are the clusters of validators that node operators are running as a single node operator, which we're starting to see in the curated module with a recent proposal. And I think this is a great example that leads into the next sort of feature here, which is sub-operators. So today in the curated module, if there's a node operator, they have one node operator entry. With curated module V2, they might have multiple. And so one of the ways to think about this is you might have your main operator type that is running very basic infrastructure, like with a single EL, CL kind of setup. I mean, multiple of them, but like fairly vanilla. But you might have subnode operator that has some portion of your keys running intra-operator DBT. And this operator type might have a different bond requirement. It might have a different fee type to recognize the need for the DBT provider fee. In other examples, maybe a node operator wants to run some portion of their infrastructure in a more challenging geography that's beneficial for network health. This could be a way to basically incentivize node operators to do that in a way that's helpful for them and for the overall health of the network. So next is bonds. So today, curated module operators do not provide any bond. However, in curated module V2, this will be a prerequisite for uploading keys and also could potentially influence stake allocation. So as the curated module will still be a permissioned module, it is expected that the bonds will be meaningfully smaller than in the permissionless modules. However, it will contribute to both reducing the protocol's overall risk profile and giving more coverage. These bond types also, as I mentioned, could be different across like different node operator types. And so there will be more information to come on this in the future. Next, and I think this is a really interesting feature that, especially when tied in with this idea of Valmart, will drive a lot of interesting conversation over the coming months. And so this is the idea that node operators within the module would potentially be able to set different levels of fees for validators at different like levels, different subsets of keys. Basically, the important point here is that running validators do not have linear costs. And especially when MaxiB is implemented and node operators are able to scale down some of their infrastructure, this looks quite different. So for example, a node operator might be saying, we're willing to run the first 2,000 keys at a 3.5% fee, but if we were able to run another 5,000 keys, we would do that at 1.5%. And then combining that with all of the other mechanisms that would be taken into account with Valmart, basically you could have a protocol that takes into account fees, performance, and importantly on performance, disincentivizing negative performance rather than centralizing the network to focus on eking out the best performance. It could take into account node operator type. So if the protocol wanted to incentivize multi-operator DBT, potentially give more weight there. if the protocol wanted to incentivize more validators in Latin America or Africa, for example, potentially could add incentivization for stake there. And two other features would be the addition of extra bond, which would provide more coverage to the protocol, as well as the ability to lock LDO and participate in Lido DAO governance. And so all of these different weights could be taken into account to have a stake distribution that, while would look different today, where it's basically flat across the curated module, could really lead to meaningful ways to both incentivize node operator decentralization, infrastructure decentralization, and change the way that the DAO currently collects fees. So in summary, it's a lot of information, I know. In Q4 2025, so just in the next couple months, it's proposed that the fee rate for curated node operators is reduced to be more in line with the market, and to really start focusing investments on growth. During the next Lido Poolside Call and token holder call, there will be a lot more information about this. In 2026, we're expecting to add staking router v3 if accepted by the DAO, which would support consolidations and market-driven stake allocation. And the curated module v2 will also introduce variable fee curves, bonding, node operator types. All of this would really increase the automation of the node operator set in terms of the processes that are currently undergoing within the curated module. And it would also be a way to help continue supporting infrastructure decentralization with these different kind of node operator types and fee setups, as well as supporting continued client team development. So that's it for me, and happy to take any questions.
Super. Well, thank you so much. So a couple of questions here. So the first one, what's the expected impact of basically subsidizing extra effort or client team node operators on the protocol?
So given that the fee rate in general is at 5% for all node operators today, you could be argued that there's been some level of subsidization for all node operators, given the way that staking rates have come down or staking fees have come down. So I actually think that there would be like a lot more net benefit of making these changes. I think it's very, very important that Lido continues to be like a leader of supporting the decentralization of the Ethereum validator ecosystem. I think this is one of the really, really strong points of Lido in the staking ecosystem, which is increasingly focused on APR maxi and less on decentralization. Making sure that the clients that support all of the validators on Ethereum are well funded is very, very important. And these validators and these client teams specifically add a lot of value to the ecosystem, as well as to Lido node operators. When there's issues, they're the first ones there to help troubleshoot.
Next question. So why have we to categorize node operators? What's the purpose and what does this affect?
Yeah, so node operator categorization, which is this concept of node operator types, allows basically to have different parameters for different kinds of node operators. So for example, a node operator that is running a very simple setup of just like normal kind of execution layer, beacon node validator client, looks quite different from a node operator that might have four nodes running in an intra-operator DVT setup, or taking that even more to an extreme, like in a 7-person DVT cluster. And so these different node operator types allow the protocol to reason about this in a way where if you have 7 people running validators and there's a DVT provider fee, potentially this cluster needs to have a slightly higher fee rate, but also that cluster might need to have or could potentially have a lower bond because there's less risk and it's providing a lot of benefits in terms of resilience and infrastructure decentralization versus a single node operator type. So I think there's a lot of different ways you can come at this, but in general, not every node operator is the same. A node operator that is running infrastructure in underrepresented geos. And so a lot of the Ethereum network validators run in North America and Western Europe. And those are places that have very mature and developed infrastructure, have a very different cost profile versus someone that's doing it in the middle of Africa, for example. And so making sure that there is a way to incentivize people to continue supporting the decentralization of the network via this categorization or node operator types is quite important.
And our next question. So how has the feedback been from operators on this change so far?
Yeah, it's a good question. I think for the most part, quite positive. There is still some things to figure out, especially around the features for staking router v3 and how stake allocation will work, because this is a very big change versus the way stake allocation has worked historically for the last 5 years or so. In terms of the fee change, which I think is probably the big open question, Generally, I think node operators are the first to kind of have told us, like, we're able to take lower fees when we run large amounts of stake. And being a node operator in the curated module means that you're running a significant amount of validators. So I don't think there's been a lot of surprise that fee rates have been suggested to come down. And there has been, some fair warning as well with CSM v2, where the fees have also already come down.
Great. And our final question, how will bonding help in validator set improvements?
So I think in this case, there's two things I would say. First, it is additional coverage for STE folders. And in the case of minor downtime or slashing incidents, being able to automate the penalization of bond is a very, very powerful feature versus having to do things manually, making sure that the protocol is basically protected in a more automated way. It's not a silver bullet necessarily, as bonds will only cover a certain amount, but it does lead to incremental improvement.
Perfect. Will, I lied. I'm sorry. There is one extra question. So will there be a lower limit for the commission percentage for operators?
So this is something that I think is very possible. It's still under discussion. One of the things I probably should have mentioned in terms of stake distribution is that there will be a maximum amount of validators that a node operator can run, and there will either also be a minimum or a difference between how big the largest node operator and smallest node operator can be, which would be effectively a minimum. So to avoid this race to the bottom, we want to make sure that there are mechanisms in place that doesn't allow one or two node operators to capture the entire market share of Lido, for example, and make sure that there is a sustainable business model for a node operator to participate in the protocol.
Great. And yeah, I think we've completed our questions. Well, thank you so much for the presentation. It was super informative.
Thanks a lot. Appreciate it.
So I think we've actually reached the top of the hour and we are now finished. So a big thank you to everyone for joining us today. It's been a fantastic discussion over the past hour. We really hope you enjoyed the conversation with Bitwise. So Bradley, VanEck, Matt, and then Davila from WisdomTree. I think they gave some really good and valuable insights into, I suppose, the future benefits that Steep can unlock for ETPs and ETFs across Europe, Asia, and America. I should also say, if you're considering deploying capital, now is the time to signal demand to your custodian exchange and express your interest in these products, or to get Steep listed on the relevant exchanges. Also, one quick point on ST Vault's testnet 3 is actually live. So this is your final opportunity to explore the platform before Lido v3 goes live on mainnet. Audits are in their final review and will be shared publicly once complete, so don't miss the chance to test, provide your feedback, and get ahead of the curve. So again, for me, thank you so much for attending the call today.